Hi, my name is Lisa Rodriguez, Director of Sales here at NuView Trust Company. And today we have the pleasure of sitting here with Adam Gauer, who is the co-founder and COO of Plus Brand Industries. He has 21 years of experience in building businesses that include an internationally recognized functional fitness apparel company, a mortgage finance service business in the top 10% of producers nationally, and also contributes as a COO of Restore FX, one of the fastest growing automotive service businesses globally and leaders in paintless clear coat repair. He is a husband and father of three. He was previously a competitive CrossFit athlete, and his entire family of five has caught the bug. They know how to push through challenging workouts several times per week at their home in Langley, British Columbia. And any additional free time that he has is happily spent coaching their individual basketball, hockey, and competitive CrossFit pursuits. So welcome, Adam Gauer.
Thank you so much, Lisa. So happy to be here. I appreciate you having us on.
Yeah, absolutely. And today we're going to focus on the asset class product sale royalties. Could you provide a brief summary for our viewers that describes how product sale royalties work?
Yeah, absolutely. So product sale royalties or just royalties as an asset class in general are actually a class that people are probably more familiar with than they may even think that they are. We often talk in these type of circles about equity and debt financing and that sort of thing as it relates to business growth. But royalties are actually very, very common and have been used for a very, very long time. It's just been consolidated more so to some typical industries. And that's why we don't necessarily think of them as being commonplace across the board, but things like oil and gas, minerals, mining, exploration, entertainment, whether it's book authors or music royalties, that sort of thing. Those are industries where royalties are actually very, very commonplace. So they're all around us, and it is a massive industry. But in terms of an alternate vehicle in light of the conversation we're having now, maybe one that people aren't as familiar with. Certainly from the retail investor standpoint, it can tend to be a little bit more of an institutional vehicle. But at the end of the day, the easiest way to think of a royalty or a product sale royalty is really a share in the performance of something, whether it's an asset or a company or sales, whatever the specific case might be. It's a way for the royalty holder to share in the performance of that asset or company. So it's a way for creators oftentimes. And when we think of, again, music, entertainment, that sort of thing, it's a way to leverage the value and monetize the value of an asset. But it's also a great way, and this is, we'll talk about this probably a little bit more as we dive a little deeper into the topic, but it's also a great way for companies to be able to access growth capital, and for those investors then to be able to, in return, receive a cut of the sales revenue from the business. So it's in that way, it is something that is not quite as common as say equity or debt and that sort of thing, but is becoming a lot more common. And that's really something that our company Plus Brand is really pioneering and creating a lot more awareness in terms of the availability of it as a vehicle to growth and to capitalize on opportunity in high growth companies.
Okay. And Adam, what would you say are the primary benefits of product sale royalties?
There definitely are some standard benefits to royalties in general, whether they're product sale royalties or, again, some of the asset royalties related to the different industries that we see them used in commonplace. One is just like investing in, let's say, a public company through stock in the stock market. It provides a hands-off approach where an investor is not responsible for the day-to-day operations of that investment. So that's one of the benefits of royalties, is it does provide that hands-off, more passive income approach, where you don't necessarily have to be as involved in the investment itself. Unlike typical stocks and companies in publicly traded companies in the market, it's not subject to fluctuations nearly to the same degree. Typically, someone will buy equity in a company in order to see that equity appreciate or depreciate. And as a result of that, you have a lot more external forces and fluctuations that you have to be cognizant of and stay aware of on a day-to-day basis in terms of tracking that investment and making sure that you're keeping an eye on the progress or lack of progress. And that is not something that needs to be considered nearly as much from a royalty perspective, because you're simply just buying into a stream or a cash flow, an income cash flow that isn't about the appreciation or depreciation. So that definitely is a benefit as well. The lack of fluctuation. At the end of the day, it makes it typically a royalty a much more stable investment from that perspective. You don't have to worry about, oftentimes, again, when we talk equity, you have to be concerned with things even outside of the performance of a particular company or asset itself. Things like market sentiment, which are often driven by a million different reasons outside of the performance of the business itself. An example of that would be, let's say a blue chip stock has no material news or anything that comes out during the course of a week. It still can be subject to a decreasing market cap or a decrease in value of those investments if for some reason something takes place in the industry as a whole that leads investors to believe that maybe in the long term there's not as much upside, or they need to be aware of something taking place in terms of even logistics. We've seen certainly through COVID where you have logistics and supply chain issues. And so general market sentiment can affect specific companies and the value of those companies. So you don't have to worry about that so much from a royalty investment perspective, which is definitely another benefit. Diversification in general, I mean, the same could be said about other asset classes too, but diversification, we generally all agree, is a healthy thing. And so this creates an opportunity more and more so now as this becomes an asset class that's more available to the average retail investor. And we'll talk about why that is in a little bit. But it allows them to have the opportunity to diversify, to be involved in cash flowing assets. Again, a lot of other traditional equity assets are more about appreciation or depreciation, not so much cash flow. And certainly from a retirement perspective, a lot of the clients that NuView Trust has, that you work with on self-directed IRAs, that sort of thing, a lot of those clients are looking to be able to create additional income streams because they're no longer working or they're winding down working, and they're looking at ways to diversify their income streams and create steady income streams. And you can do that with a royalty investment because it is actually a cash flowing investment, unlike where you might be dependent on hoping that a dividend gets paid, but even then the frequency of that and the amount of that may not necessarily be something that can factor into retirement and covering just general living expenses going into retirement. So this is a cash flow, and a meaningful cash flow, that can be created for investors in royalties, where they can depend on that and it can factor into those investment goals going into those different stages of life, where at the end of the day, retirement or not, all of us want to look to diversify our sources of income. As again, the last 3 years have shown that there's instability can come in a lot of different ways and affect each of us in our different jobs and our companies. And so having a diversified source of income and multiple sources of income becomes even more and more important. We don't want to be particularly dependent on just one single source. So royalties can be great from that perspective as well for the average investor.
Okay. And I mean, this is an asset class that has existed for quite some time and is very well established. Do you see the applications for royalties broadening beyond the typical industries where we've seen them before, oil and gas, music, minerals?
Yeah, that's really where we see the biggest changes happening right now. And again, with Plus Brand, what we're doing is we're leveraging the benefits of that. And a lot of other companies are doing this now. They're leveraging the benefits of royalties for investors in terms of some of those things that we just talked about, but also for companies as well, to their benefit, to access growth capital, and particularly in high growth industries where valuations of businesses and sales are growing very, very quickly. So I definitely see this broadening to a lot more applications outside of, like you mentioned, those traditional oil and gas, minerals, entertainment, that sort of thing. It's something that can and is now being utilized a lot more. And you see that even anybody who watches, let's say, a show like Shark Tank, and you've got Mr. Wonderful on there, Kevin O'Leary, who's got his big, bubbly, pessimistic personality. And he's often now talking more often than not about royalty deals that he puts together versus equity deals. And so it is becoming a lot more commonplace. But where I see the evolution taking place moving forward is a lot of early stage, high growth companies still are lagging a little bit behind in terms of taking that traditional equity finance route in order to raise that growth capital and take advantage of growth opportunity that lies in front of them. And then from there, you move on to traditionally debt financing, but that's not always available for early stage investments. That's more as they begin to mature. So those are the traditional routes. And a lot of startup and early stage and high growth companies still take advantage of that. But where we see that transition taking place now, certainly with the democratization of the internet and the democratization of investing in general, now where we can communicate, and the average company or the average fiduciary or custodian can communicate much more easily directly with investors to be able to provide updates, to be able to tell brand stories, to be able to keep them up to date with how companies and assets and sales are developing and progressing. It's made the world a much smaller place now. And we see examples of that with crowdfunding over the last even 10 years now. Crowdfunding has just taken off. And a lot of retail investors now get that opportunity to participate in earlier stage companies that they wouldn't have otherwise had the opportunity to participate. But the big difference there is that crowdfunding, which we've seen it raise, and we've all seen examples where it'll raise millions of dollars, sometimes in a 24-hour period. But they're still doing that with the traditional, typically with the traditional equity finance vehicles. And so where I see it broadening moving forward, to kind of circle back to your question, is I see a lot more companies now leveraging finance options because investors are realizing it's a great way to diversify, a great way to lock in stable, consistent cash flow where they don't have to worry so much about the ups and downs of the market, and take advantage of those benefits. But the companies as well can retain a lot more equity in those early high growth stages, which is actually a benefit for both parties, because the same people that drove the business to that point continue to be highly incentivized to continue to move it forward. So we really see this being a vehicle that a lot of other companies will begin to transition from some of those more traditional models to these alternative vehicles like royalty financing, which is great. And that's why it's so important for companies like NuView Trust to exist, where you guys have done such a great job of creating environments as a custodian where customers of yours and clients can come in and be able to choose from some of these different alternative vehicles that exist. And it's never been more important than it is now. And we'll talk about this in just a moment. But with the way that a lot of the markets are performing over the last couple of years, alternatives become critical for people to look at.
Mm-hmm. I know you answered some of the question around, why accredited retail investor or institutional investors should consider royalties. Are there any other points you'd like to make in regards to that?
Yeah, at the end of the day, one of the last things that I would say there too is the rate of return. Royalties can typically offer the opportunity for a higher rate of return, which for both the institutional investor as well as the accredited investor is particularly important given the inflationary environment that we find ourselves in right now. When we used to be in periods of time where inflation was moderate or under control and much more nominal, we would talk about returns and you'd hear 3, 4, 5 9% return, that sort of thing. And we typically download and translate that in our brains as being sort of the holistic return, because inflation wasn't something that we were necessarily thinking about so much in the back of our minds. But now that's obviously, that picture has completely changed, and inflation is something that is rampant in the current market. So you can't pursue, the average accredited retail investor or institutional investor can't pursue the same returns that they would have maybe 3 years ago prior to inflation really ramping up. Because if you adjust that now for inflation, oftentimes you're being left behind and you're actually technically losing money if that return's not high enough, or not achieving the target return that they want to be achieving once it's been adjusted for inflation. So in these sort of these markets that are fluctuating and there's a lot more turmoil from high inflation, royalties can be a great alternative, because they can typically, especially as they're being utilized now more so by high growth companies, they can offer a higher return that, once you adjust those for inflation, are still providing the returns that people want to see in order to, one, be able to just maintain wealth if that's the stage that they're in, or build wealth if that's the stage in the investment goal. So that can be harder to do with the returns of 3, 4, 5 years ago, because now we've got this inflationary environment that we're dealing with. So that's definitely a very important consideration, and one that would certainly point in the direction of an alternative investment vehicle or class like royalties. I think one of the main reasons why it's important for accredited retail investors and institutions to be considering royalties in their portfolio at this point in time really is being answered in large part by the current existing markets right now. I mean, we've seen, certainly in the last year and a half in particular, we've seen a year where in 2022, the market in general had its worst year since 2008. 2008 is a year that rings a lot of bells and carries a lot of connotation with it for a lot of us. But in general, there's really almost no better word than carnage in terms of what's taken place there with even just blue chip public companies. So it really has most of us in a position where, again, you and I as retail investors and institutions, the onus starts to transfer more and more on us, like we talked about, to be creative and evaluate these other alternatives, because just because something has been done a certain way traditionally within investment portfolios for a long period of time doesn't always mean that it's the best way moving forward. So it's important for us to take our own ownership of those portfolios and evaluate these options, because we don't need to just accept the status quo of, okay, well, the S&P is down 35% this year, or even US Treasuries, which are typically one of the most stable places you can put your money. In 2022, those were down over 30% on the 30 years. So these commonplace investments that are typical safe havens, more or less, have not been creating great returns. But it doesn't mean that we just need to accept that as the status quo when there are these other great alternatives. And we talk about the history of royalties. Over $100 billion a year are paid out in royalties. So again, this is not some new asset class. It's just one that's starting to be utilized now in very, very different and creative ways that can be a great benefit to the investors, both institutional and retail.
Okay. And then what are some factors that investors should consider or keep in mind when evaluating potential alternative royalty investments?
Yeah, that's a great question. So there's, again, this can be useful to keep in mind regardless of whether it's a product sale royalty or regardless of the industry that the royalty is being found in. There's often standard terms within agreements, but they do vary from agreement to agreement and company to company. So one of the most important things right off the top that an investor is going to want to consider is the payment term. You have anything from annual to quarterly to monthly. And so that while that sounds like it's just something that is not necessarily as important as the return that's being generated, it is very important because you got to make sure that it matches with the goals of the particular investor. For example, if someone is, if let's take a NuView customer who might be in a self-directed IRA that gets involved with a particular royalty, if they're looking at providing additional cash flow that subsidizes actual cost of living in retirement on a month-to-month basis, a quarterly or an annual royalty is probably not going to line up very well with that. You're going to want to look for something that has a payment frequency that matches with that investment goal. So payment term is definitely something that is important to consider. Another one is, like we just talked about, actually really having a handle on what that inflation adjusted return is. Because again, we're so used to just hearing a particular return. So a company might pay X% per year on average, but we have to filter that now through this high inflation environment. We really don't even have the opportunity, as whether retail investors like you and I or institutions, we can't even be afforded the opportunity to just sit by and do nothing anymore. That whole adage or idea of saving for a rainy day or leaving money sitting in a savings account is not an option anymore, because that decision to do nothing is not so much prudent as it is destructive, because now anything that's just sitting there and that choice to do nothing is actually moving backwards. It's like we've always heard, if you're not moving forwards, you're actually moving backwards. Well, that's very, very much the case right now. And so it becomes more important to get creative and look outside of the traditional alternatives. And so that's what you get with royalties. But then like we talked about with this second thing to look at, is you really want to make sure that when you're measuring the return that will come through a particular royalty, you want to adjust it for inflation and make sure that you're not making any assumptions. There are royalties where it's simply just a cut right off the top and it doesn't promise a particular return. It's just, well, whatever sales end up being, you get this percentage of it. So you really need to take a look at the asset or the IP or whatever's tied to that royalty and ask yourself the question, does this possess the capacity to provide a return that will allow me, once adjusted for inflation, to have my money working in the way in which I really need it or want it to, rather than just assuming that will be the case. So it's important to make those comparisons against inflation and not just assume that it'll provide a rate of return that will be satisfactory for your investment goals. And that's where, like NuView always does a great job of qualifying. It's important to have those discussions with your financial advisor, with your fiduciary, to make sure that these different things are lining up with your expectations and what you're hoping to achieve with your portfolio. A ramp up period is an important thing to consider, especially like we talked about now, as royalties become a vehicle that are utilized more by high growth companies. It's important for royalty holders in those instances to understand that while there is an average rate of return through the course of that royalty lifespan, there will be a ramp up period with ebbs and flows initially, and you might see slower and or lower returns initially at the startup phase, and then higher and more frequent payments as you get through into more of the maturity phase. So there will be that average, but it's important, again, to sit with your financial advisor and make sure, okay, well, with what my goals are, if it's going to be a company that ramps up in the first year and the royalties could be expected to be here with a few more ebbs and flows before they average out and then get above that average to balance things out, is that something that can work with my portfolio and with my objectives? So it is important to understand that with any type of royalty, there traditionally is some sort of a ramp up period that needs to be understood and factored into those investment decisions when making those. But at the end of the day too, a real important thing to consider when looking at and evaluating certain specifics of a royalty agreement is, like we talked about a moment ago, the asset itself. Because royalties will typically have a term, whether it's just a cut off the top that you're constantly paid on an ongoing basis, or whether it's for a period of time, or whether it's up to a certain return. The royalties will all have a varying term attached to them. And so what you want to do as an investor or as an institution is make sure that you, certainly for yourself, believe that the asset or the company or the IP that the royalty is tied to has that longevity. And that's become even more and more obvious and important now, as we've seen companies can have really, really rapid growth and provide great returns. But a lot of things now are tied to fads and trends. And so while they might see a really, really high rate of return, it's for a very, very brief period of time. So you want to make sure that you're not getting involved with an expectation that the royalty will be sustained over a long period of time, or that the return will be sustained over a long period of time, if it's an asset or an IP that may be incapable of having that longevity for that period of time. If it is, like we say, for example, more of a trendy product or asset, because that's becoming more and more commonplace where things move, especially now. Again, we talk about the access that we all have through social media and companies that grow so quickly through these different platforms. They tend to be trendy. And so we want to make sure that when we're looking at royalties, that we're getting involved with something that has that staying power, so that it's something that you can make sure that you can actually see that return over a longer period of time that you expect and that you hope to see, and that matches with those investment goals that you might have as an individual investor.
Wow, that was some good information. Thank you so much, Adam. We appreciate your time and your knowledge behind this topic. Product sale royalties is definitely an asset class that we mentioned earlier, has been around for some time and potentially has some opportunity here for broadening its horizon. So thank you. Yeah, well, go ahead. And if anyone has any questions or further discussion is warranted with Adam, you can reach him. We're going to go ahead and post his company information at the bottom of the screen. And again, we thank you for your time today.
Yeah, you're very welcome. Thank you so much for having me, Lisa. I really appreciate it.